To be a successful trader, not only you must learn excellent risk management rules, but also you need to firmly implement them. Excellent traders watch their account as careful as scuba divers watch their supply of oxygen. You must have a line in the sand that tells you when to get out of a trade. It's going to be necessary from time to time to admit defeat and say, I was wrong, or the setup isn't ready yet, or I'm getting out of the way. And that acknowledgement must come in a timely fashion. Waiting too long to exit a trade can literally wipe out your entire account. I'm a consistently profitable trader, but I still lose frequently. That means I must have found a way to be a really good loser. Lose gracefully. Take the losses and walk away. If a trade goes against you, exit the trade. In day trading, the unexpected will occur. This is the name of the game. There is always another trade and another day. Holding a position that is trading against you because you are primarily interested in proving your prediction to be correct is bad trading. Your job is not to be correct. Your job is to make money. This career is called trading, not predicting. I can't emphasize enough how important it is to be a good loser. You have to be able to accept a loss. It's an integral part of day trading. In all of the strategies that I explain in Chapter 7, I will let you know what is my entry point, my exit target, as well as my stop loss. You must follow the rules and plans of your strategy, and this is one of the challenges you will face when you are in a bad trade. You may very likely find yourself justifying staying in a bad trade by saying, well, you know, it's Apple, and they make really great smartphones. They're definitely not going out of business. I'll just hold this a little longer. You do not want to do that. You must follow the rules of your strategy. You can always get back in, but it's hard to recover from a big loss. You may think, I don't want to take a $50 loss. Well, you definitely don't want to take a subsequent $200 loss. And if you ended up taking an $800 loss, it would be really hard to recover from that. Take the quick losses, get out, and come back when the timing is better. Every time you trade, you're exposing yourself to the risk of losing money. How do you minimize that risk? You need to find a good setup and manage the risk with proper share size and stop loss. Here is my next rule. Rule 5. Success in day trading comes from risk management. Finding low-risk entries with a high potential reward. The minimum win-lose ratio for me is 2:1. A good setup is an opportunity for you to get into a trade with as little risk as possible. That means you might be risking $100, but you have the potential to make $300. You would call that a 3-to-1 profit-to-loss ratio. On the other hand, if you get into a setup where you're risking $100 to make $10, you have a less than 1 risk-reward ratio, and that's going to be a trade that you should not take. Good traders will not take trades with profit-to-loss ratios of less than 2-to-1. That means if you buy $1,000 worth of stock, and are risking $100 on it, you must sell it for at least $1,200, so you will make at least $200. Of course, if the price comes down to $900, you must accept the loss and exit the trade with only $900. Let me explain the risk-reward ratio in a real trade that I took. Molina Healthcare, Incorporated, was on my watch list on February 16, 2017. At the open it was strong and it then went higher. I was watching it. Suddenly, around 9:45 a.m., most started to sell off heavily below volume-weighted average price (VWAP). See Chapter 5 for some detailed commentary on my indicators. I decided to sell short Mo below VWAP at around $50. My profit target was the next daily support of $48.80. That was a $1.20 reward per share. My stop loss naturally should have been when the price of Mo went above VWAP, which in this case was $50.40, as marked on figure 3.1 below. I could risk 40 cents per share in the hope of rewarding myself $1.20 per share. That is a 1-3 risk reward. I indeed took this trade. Figure 3.1- Screenshot of my trade on Mo on February 16, 2017 showing my entry, exit and stop loss. As you can see, the profit to loss ratio is 3-1. Now imagine if, in the above example, you missed the opportunity at 9:45 a.m. when the stock was being traded at around $50.20, and instead you went to go short a few minutes later at around $49.60 with the profit target of $48.80. In this case, your reward would be around 80 cents per share, but your stop loss should be above WAP at around $50.20. In this case, you are then risking 60 cents per share to reward yourself 80 cents per share. This 1.3 ratio is not a favorable profit to loss opportunity that I want to base a trade on. In this case, I would accept that perhaps I missed the opportunity. You may say, okay, if my entry is at $49.60, I will define a closer stop loss to have a more favorable profit to stop loss ratio? The answer is no. Your stop loss should be at a reasonable technical level. Any stop loss below VWAP is meaningless in this case, because the stock can make a normal pullback toward VWAP at any time and then continue to sell off toward your target. This is actually what happened when, at around 10:20 a.m., Mo's price pulled back toward VWAP, but did not reach to the VWAP, and then sold off toward $48.80. I've marked this on figure 3.2 below. If you had to find a stop loss anywhere below VWAP, most likely you would have been stopped out at a loss. Figure 3.2- Screenshot of Mo on February 16, 2017. This is the example of a bad risk reward. As you can see, the profit to loss ratio is less than 2-1 and is not tradable. You have missed the opportunity. If you cannot find a setup with a good profit to loss ratio, then you should move on and keep looking for another trade. As a trader, you are always looking for opportunities to get low-risk entries with big win potential. Being able to identify setups that have a big win potential is also part of the learning process. As a beginner trader, you may not be able to differentiate between a range of setups. It may be difficult for you to recognize what a home run bull flag is and what will end up being a false breakout. That's something that comes with both experience and training. We will cover this in more depth in the coming chapters. You can learn from videos on YouTube and Google. You can also join our chat room where I explain my trades in real time while I am trading them. You will be able to observe me, my monitor and my trading platform. Using a 2-1 win-lose ratio, I can be wrong 40% of the time and still make money. Again, your job as a day trader is managing risk. It is not buying and selling stocks. Your broker is buying and selling stocks for you in the market. Your job is to manage your risk and your account. Whenever you click buy in your trading platform, you expose your money to a risk. How do you manage that? You essentially have 3 steps in managing risk. You need to ask yourself, 1. Am I trading the right stock? Do remember that risk management starts from choosing the right stock to trade. You can have the best platform and tools and be a master of many strategies, but if you are trading the wrong stock, you will definitely lose money. Chapter 4 focuses on finding the right stocks in play for day trading. I will explain in detail how to find stocks that are suitable for day trading and what criteria you should look for in them. You must avoid stocks that are heavily traded by computers and institutional traders, have small relative trading volume, are penny stocks and are therefore highly manipulated, and don't have any reason to move. I will explain these points in more detail in Chapter 4. 2. What share size should I take? 1 share, 10 shares or 100 shares? What about 1,000 shares? This depends on your account size and your daily target. If you are targeting $1,000 a day, then 10 or 20 shares might not be enough. You either have to take more shares or increase your account size. If you don't have enough money to trade for a $1,000 daily target, you should lower your daily goal. I am holding around $25,000 in my trading account, and I usually choose 800 shares to trade. My daily goal is $500 or $120,000 here. That is sufficient for my lifestyle. What is your trading goal? 3. What is my stop loss? An easy way to remember what your stop loss should be is to think about a carton or jug of milk. That's right. Milk. 2%. You should never risk more than 2% of your account on any given trade. If you have saved up sufficient funds and have $50,000 in your account, you should never put more than 2% at risk, in this case, $1,000. If you have only been able to save up a modest amount of funds for day trading, then you have no choice but to trade in smaller numbers of shares. Make it one of your unbreakable rules. It will be difficult to move on, but if as you stare at your monitors you see a possible setup that could cost you more than 2% of your trading account, just move on and look for another trade. With every single trade you make, you should always ensure that at least 98% of your account is protected. 3-step risk management. Step 1. Determine your maximum dollar risk for the trade you're planning. Calculate this before your trading day starts. Step 2. Estimate your maximum risk per share, the strategy stop loss, in dollars, from your entry. This comes from the strategies set out in Chapter 7, where I explain in each strategy what the stop loss should be. Step 3. Divide 1 by 2 to find the absolute maximum number of shares you are allowed to trade each time. To better illustrate this, let's return to the example of Mo from a few pages back. If you have a $40,000 account, the 2% rule will limit your risk on any trade to $800. Let's assume you want to be conservative and risk only 1% of that account, or $400. That will be step 1. As you monitor Mo, you see a situation develop where the VWAP strategy may very well work in your favor. You decide to sell short the stock at $50, and you want to cover them at $48.80, with a stop loss at $50.40. You will be risking 40 cents per share. That will be step 2 of risk control. For step 3, calculate your share size by dividing step 1 by step 2 to find the maximum size you may trade. In this example, you will be allowed to buy a maximum of 1,000 shares. In this case, you may not have enough cash or buying power to buy 1,000 shares of Mo at $50. So instead you will buy 800 shares or, perhaps, even 500 shares. Remember, you can always risk less, but you are not allowed to risk more than 2% of your account under any circumstance. With the strategies introduced in Chapter 7, I explain where my stop loss would be based on technical analysis and my trade plan. I cannot consider maximum loss for your account because I of course don't know your account size. You need to make that judgment for yourself. For example, when your stop would be above of a moving average, you need to calculate and see if that stop would be bigger than your maximum account size or not. If break of moving average will yield a $600 loss, and you have set a $400 maximum loss per trade, then you should either take fewer shares in that trade or not take that trade at all and wait for another opportunity. You may correctly argue that it will be difficult to calculate share size or stop loss based on a maximum loss on your account while you are waiting to jump into a trade. You will need to make a decision fast or else you will lose the opportunity. I understand that calculating your stop loss and maximum loss in your account size in a live trade is difficult. Remember Rule 2? Day trading is not supposed to be easy. Trading needs practice, and I strongly recommend that new traders paper trade under supervision for at least 3 months in a live simulated account. It sounds crazy at the beginning, but you will quickly learn how to manage your account and your risk per trade. You will be amazed at how rapidly the human brain can do calculations on what share size to take and where to set the stop loss. Trading psychology. A burning question for many when they begin their trading career is, why do most traders fail? To answer that, let's imagine 3 different traders place an exact same trade and all of them lose money. However, the way they react to their losses can be the catalyst that determines their eventual trading results. One trader might become discouraged, curse the market, and give up for the day. Another trader might become frustrated, trade more aggressively to recoup his earlier loss, and end up losing even more that day. A third trader will take a break from trading, walk out for a few minutes to reassess her emotions, come back to reevaluate her strategy, wait for a clear signal of opportunity, and then place a good trade that brings her even by the end of the day. What is fundamentally different about these traders? The answer to these 2 questions is that success and failure are based on how traders behave and how they control their emotions. That is what distinguishes between the winners and the losers. A key reason why many traders fail is that they take negative events and losses in trading personally. Their confidence and peace of mind are connected to their trading results. When traders do well, they feel good. When they encounter losses, they become discouraged, doubtful, and frustrated, questioning themselves, their strategy and their career. Instead of dealing directly and constructively with their losses, they react to the emotions triggered by personalizing the events. Successful traders are those who trade for skill and not for the money. Almost all professional traders hide their unrealized profit and loss column while in a trade. They have no interest in seeing how much they are up or down. They focus on the perfect execution of a profit target or a stop-loss level. Consistently profitable traders take every negative or positive trade they make as an opportunity to improve themselves. Day trading requires you to make quick decisions while at the same time being very disciplined. Every morning, you should scan the market, find the opportunities, and sometimes in a matter of seconds make decisions on whether you should buy or sell short the stock in play, and you need to make that call with a high degree of discipline. One of the key contributors to traders' self-discipline is their physical and mental health. People who eat well-balanced nutritional meals, exercise regularly, maintain proper body weight and fitness levels, and get adequate rest are likely to have the levels of energy and alertness that are required to make them effective traders. You may be surprised to read this, but your state of alertness, your energy level, and your overall health have a significant impact on your daily trading results. Those who neglect these aspects of their well-being or, even worse, abuse alcohol or drugs, will find it difficult to concentrate and make good decisions. Fatigue, physical tension, and ill health will often affect your concentration and adversely affect your sound decision-making process. It is difficult to make and sustain the required mental efforts for day trading when you lack proper sleep or feel down from a lack of exercise. Very often, your moods are influenced by your physical state, even by factors as delicate as what and how much you eat. Keep a daily record of both your trading results and your physical condition, and you will see these relationships for yourself. Begin preventive maintenance by keeping your body, and thus your mind, in their peak operating condition. Aspects of personal lives outside of trading can also affect effectiveness as a trader. Changes in personal relationships such as breakup or divorce, family issues like illness, and financial problems can reduce a person's ability to focus and make appropriate decisions. For example, it is common for young traders to experience more stress after they have married, had children, or purchased a new home, because these added financial responsibilities create additional worry and stress. It certainly took time, but I found that the more and more I practiced, the more effectively I was able to execute my trading strategies. Real success though did not come until I was able to control myself and practice self-discipline. It's very challenging to predict what the stock markets will do on any given day. Your success will be very limited, and any success will almost exclusively be based on pure luck, if you yourself do not know in advance what you will do before you enter a trade. You need to have a well thought out plan, and you need to follow that plan. New trading strategies, tips from showrooms or from this book, or even the most sophisticated software imaginable, will not help traders who cannot handle themselves and control their emotions. For every trade, you must ask yourself some questions. Does this fit into my trading personality and my risk tolerance? What strategy will this fit into? If this trade goes the wrong way, where's my stop? How much money am I risking in the trade, and what is the reward potential? This is what many traders find difficult. All of these decisions, the very process of ensuring these decisions fit into your risk tolerance and your strategy parameters, are a tough multitasking call. Not only is it multitasking, but it is multitasking while under stress. I understand that stress. There have been times when I've been in the trade, had an $80,000 position, and all I needed to do was to sell. But as I was looking at my keyboard, I found myself frozen like the proverbial deer in the headlights. I couldn't even figure out which keys to punch. This sort of paralysis is not unusual when you're overwhelmed. It happens to every single one of us. But remember, confidence in trading doesn't arise from being right and profitable in all of your trades. It comes from surviving the occasions of being wrong and losing money. Trading is stressful. Active day trading is perhaps the most stressful of all trading periods. One mistake can ruin your month. One missed proper profit taking can ruin your week. There is a fine line between being a good trader and being a losing trader. If you are under pressure, don't make any trades. Take a walk to release your stress and do not restart trading until you are once again focused and calm. Often trading professionals will refresh their minds by going for a run after a bad loss, and then come back to restart trading, but in a simulator and not live until they are back on track emotionally. Be in touch with the results of your decisions and constantly be reviewing your performance. Are you trading profitably? Have you had 5 wins in a row, or have you had 5 losses in a row? If you are on a losing streak, will you be in touch with your own emotions and maintain your composure, or will you let your judgment be impaired? I cannot emphasize enough just how important the following steps are. You must take the time to prepare. You must work hard. You must plan your trades. You must take the time afterwards to review your trades, and you cannot do it alone. You cannot succeed on your own. There is so much value in sharing ideas and learning from a community of traders and, should you have one, your mentor. Consider skill and discipline to be your trading muscles. Muscles require exercise to grow, and, once you've grown them, they need to be exercised or you will lose them. That's what I experience every day, continually exercising my ability to practice self-control and discipline.